Welcome to The Explainer. All right, let's talk about stock trading. Specifically, we're going to decode one of the most fundamental tools out there, the candlestick. You know that feeling when you look at a stock chart and it's just a mess of lines? It feels like you're trying to read a foreign language, right? Well, stick with me, because today we're going to make you fluent.
I mean, that's a perfect way to put it, isn't it? For so many people starting out, stock charts are just intimidating. They look like this chaotic jungle of green and red. But I promise you, by the end of this, you're going to see that jungle for what it really is. It's a story waiting to be read. It's a map that can actually guide your decisions.
Okay, so here's our game plan. First up, the two big worlds of analysis. Then we'll dive in and decode the candlestick itself. We'll talk about bulls versus bears, get into some key patterns like the hammer and hanging man, and then, this is the important part, we'll cover the one rule you have to know. And finally, we'll see how it all plays out in the real world. Let's get started. All right, section 1, two worlds of analysis. So before we get into the charts themselves, you got to understand that there are basically two main schools of thought, two philosophies for analyzing the stock market, and they ask completely different questions to figure out what to do.
So on one side, you've got fundamental analysis. Think of this like being a detective. You're digging into a company's health. You know, their profits, how much debt they have, who's running the show. This whole process is about answering the question, what company should I buy for the long haul? But on the other side, and this is where we're going to live today, is technical analysis. This is more like being a psychologist, reading the market's mood from its chart. It's all about patterns, and it helps you answer a totally different question. When is the right time to buy or sell?
Okay, let's move on. Now we're going to zoom way in on the single most important building block of any technical chart, the candlestick. Seriously, if you can just understand this one little element, that whole confusing jungle we talked about, it starts to look a whole lot more familiar.
So what exactly is a candlestick? Well, it's not just some random red or green bar on a screen. The best way to think about it is like the highlight reel of a big game, all packed into one simple shape. It tells you the entire story of what happened during a specific time period. Could be a day, an hour, even a minute. It's the story of this constant battle between the buyers who are trying to push the price up and the sellers who are trying to drag it down.
And here's the cool part. Every single candle, no matter how weird it looks, is made from just 4 key ingredients. That's it. You've got the open, the price at the very start, the high, the absolute highest point it reached, the low, the lowest it went, and the close, the final price when the time was up. These 4 data points, open, high, low, and close, they're what give every single candle its unique shape and story.
Let's break it down. First, you have the body. That's the thick main part of the candle. Think of this as the scoreboard of the battle. It shows you the range between where the price opened and where it closed. A really long body means it was a decisive victory for one side. A tiny little body, that kind of suggests a stalemate, maybe some indecision in the market.
And then you've got the wicks, or some people call them shadows. These are the thin little lines sticking out from the top and bottom of the body. The wicks tell you the full extent of the fighting. They show you the wild extremes, the absolute highest highs and lowest lows the price hit during that period, even if it didn't stay there. It's where all the action happened before the final bell.
Right. So now we know the parts. But what's really cool is how the body and the wicks combine to tell us the story of who actually won the day. Was it the bulls, the buyers trying to charge prices higher? Or was it the bears, the sellers trying to claw prices down?
And honestly, it's pretty simple. If you see a green candle, that's a bullish candle. It just means the price closed higher than where it opened. The buyers won that round. The bulls were in control. And if you see a red candle, that's bearish. It means the price closed lower than where it started. The sellers won. The bears took that one. Green for up, red for down. Easy enough, right?
Okay, so we've got the basics down. Now we can start to get into the really good stuff, reading specific patterns that tell these incredible stories about what traders are thinking and feeling. We're going to look at 2 of the most famous ones, the hammer and the hanging man. And here's the twist. They look exactly the same, but what they mean couldn't be more different.
Let's start with the hammer. And yeah, it looks pretty much just like a hammer. You've got this small body up top and a long lower wick. This pattern is a big deal because it usually shows up after the price has been falling for a while, and it signals that the market might be hammering out a bottom. It's a clue, a potential sign that the sellers are getting tired and the buyers are starting to step in.
And this is the story that candle is telling you, minute by minute. Imagine the trading day starts, and the sellers are just in complete control. They are pushing the price down, down, down. By midday, things look really grim.
It feels like a total blowout. But then, in the afternoon, the buyers stage this incredible comeback. They start buying like crazy, and a huge reversal begins. By the time the market closes, they've pushed the price all the way back up near the high for the day. That dramatic shift in momentum, that's a huge signal. It's telling you the game has changed, and the buyers might be ready to take over.
Okay, now hold that hammer shape in your mind. Imagine that exact same shape, but this time you see it at the top of a big price run-up. Suddenly, it's not a sign of strength anymore. Now, it's a warning sign. It's called the hanging man, and the story it tells is that the buyers tried to keep pushing the price higher, but they failed. The sellers came in and forced the price back down. It's a potential signal that the buyers are losing their grip and the good times might be over.
Okay, everybody, listen up, because this next part, this is probably the most important rule in this entire explainer. Seriously, this is the one detail that separates the newbies from the pros. It's the key that unlocks everything.
So, up to this point, we've been thinking green means go, red means stop. Green is good, red is bad. Simple, right? Well, what if I told you that's not the whole story? Does the color of the candle tell you everything you need to know? The answer, surprisingly, is no, not at all.
And here it is. The big secret is this. Where a pattern appears on the chart is way, way more important than what color it is. Let that sink in. A hammer shape that shows up in a downtrend is a bullish signal, even if the candle itself is red. And that exact same shape showing up at the top of an uptrend, that's a bearish hanging man, even if the candle is green. The context is everything.
This is the golden rule right here. Location is greater than color. You have to stop just looking at the individual candle and start looking at where it is in the bigger picture. Where a pattern appears on the chart is what gives it its true meaning.
Okay, so this all sounds good in theory, right? But does this stuff actually work in the real world? Let's take a look at a few examples and see how this plays out.
So check this out. In this first example, you can see the stock price was just falling and falling. And then right at the bottom, what do we see? A hammer pattern. But look closely, it's a red hammer. Now, someone who doesn't know the golden rule might see red and think, oh, that's bad. But we know better. Because of its location at the end of a downtrend, this is a bullish signal, even though it's red.
And the result? Take a look. The stock completely reversed course and shot up, giving a 25% return in just under a month, all signaled by that one little red candle.
And hey, this wasn't just a lucky guess. The source material we're drawing from showed this happening again and again. There were other examples where spotting one of these hammers led to a 70% return, and another one that led to an incredible 85% return in just a couple of months. The pattern holds up.
So think about this. If just one simple candle pattern can tell such a powerful story, what other stories are hiding in those charts? We've only scratched the surface today, but now you know the basic language. You have the key to start decoding the market for yourself. The whole point is to stop seeing that intimidating jungle and start seeing the stories that are hiding right there in plain sight.